Welcome back. We've dealt with cash. Now we have to deal with stuff. In the tax world, we call this the benefits code. Employers often try to pay employees in perks, cars, houses, televisions, thinking it avoids tax. Your job is to calculate the cash equivalent of these perks so the tax man can treat them just like salary. Let's start with the absolute giant of the syllabus, company cars. You will see a company car in your exam. I guarantee it. The calculation is mechanical, but if you miss one component, you lose the easy marks. The formula is the list price multiplied by the CO2 percentage multiplied by time apportionment. Let's break down the traps. First, the list price. We use the manufacturer's list price when the car was new. We do not care if the employer got a massive discount or bought it secondhand. We use the official price. You must add the cost of optional accessories if they are over 100 pounds. And then there is the capital contribution trap. If an employee contributes their own money to buy the car, we deduct it from the list price. But, and this is crucial, the maximum deduction is 5,000 pounds. If your client contributes 7,000, you only deduct 5,000. The remaining 2,000 is wasted tax-wise. Next, the percentage. You will have a table in the exam, but you need to know the logic. For the 2024-25 tax year, a car with emissions of 55 grams per kilometer has a percentage of 16%. For every 5 grams you go up, you add 1%. If it's a diesel car that doesn't meet RD2 standards, you add a 4% surcharge. And remember the ceiling. The percentage is capped at 37%. Even if the emissions are sky high, you never go above 37%. Now, does the employer pay for petrol? If they do, we have the fuel benefit. The government taxes this aggressively. You take a fixed base figure of 27,800 pounds and multiply it by the same CO2 percentage you used for the car. The warning here is that this is an all or nothing benefit. If the employee pays for some of the fuel, the benefit is not reduced. It remains the full amount. The only way to reduce this benefit to zero is if the employee reimburses the employer for 100% of the private fuel used. If they miss paying back even 1 penny, you charge the full tax. Let's move briefly to vans. Vans are tools of the trade, so the tax is lighter. There is a flat rate benefit of 3,960 pounds for the van and 757 pounds for fuel. If it's an electric van, the benefit is zero. And this is important. If the van is used only for business and commuting from home to work, there is no benefit at all. This is known as insignificant private use. What if the employer provides a house? Living accommodation is a 2-tier calculation. Tier 1 is the basic charge, which applies to everyone. The benefit is the annual value, which is usually the rateable value given in the question. However, if the employer rents the property, the benefit is the higher of the annual value or the rent paid by the employer. Tier 2 is the expensive accommodation charge. If the house costs the employer more than 75,000 pounds, you must calculate an additional benefit on the value above that threshold. You take the excess cost and multiply it by the official rate of interest, which is currently 2.25%. There is a catch called the 6-year rule. If the employer owned the property for more than 6 years before giving it to the employee, you ignore the original cost and use the market value at the date the employee moved in. Also, remember the exemption. If it is job-related accommodation, meaning the employee must live there to do their job, like a caretaker or prison warden, the accommodation benefit is exempt. Finally, let's talk about assets, laptops, TVs, or furniture. If the employer lends you an asset for private use, the annual benefit is simply 20% of the market value when it was first provided. But what happens if the employer eventually says, "Keep the TV"? This is a gift of an asset. You might think the benefit is just the current secondhand value. You would be wrong. To stop tax avoidance, the benefit is the higher of 1. The current market value at the date of the gift, or 2. The original market value minus the total tax benefits already paid during the loan period. This higher of rule ensures you pay tax on the real value of the asset over its life. Master these rules, and you will navigate the employment income questions with confidence.